ABC are partners. C retires from the business and after all adjustments, his capital account had a balance of 60,000 which was transferred to loan account on 1st January 2005 to be paid in 3 equal annual installments together with interest at 10% per annum. Show partner's loan account till it is finally paid off. Accounts are closed on 31st December each year. So now students, this question makes it very clear that all the adjustments have been done, the capital accounts have been prepared, and the loan balance of the retiring partner is coming to rupees 60,000. This loan is to be paid off in 3 equal annual installments together with interest at 10% per annum. We are required to show partner's loan account till it is paid off. Now students, remember, loan is 60,000. Number of years is 3. So, installment or the annual installment should be 60,000 divided by 3, that is rupees 20,000. That means every year a principal amount of rupees 20,000 has to be paid together with the interest of 10% on the remaining balance. So now let us prepare loan account and see how these entries would be posted. C's loan account, debit side, credit side, the format is same, date, particulars and amount. Now students, the first journal entry is the entry for transfer of balance of capital to loan account. That is C's capital to C's loan account. So this posting represents that particular journal entry. This amount has been transferred from C's capital account. So on the first date by C's capital account, 60,000. Now, at the end of this year, that is 31st December 2005, it is clearly mentioned in the question that the accounts are closed on 31st December each year. Interest on the balance outstanding would be due. Interest account would be 10% of 60,000, which is 6,000. Now students, on the same date, since it is the last date, 31st December 2005, payment would be made as to bank, which will be on the debit side. 20,000 is the installment plus 6,000 is the interest. So total 26,000 would be paid and the remaining would appear as your balance carried down. This is 66,000 total on the credit side. Out of 66,000, we'll deduct 26,000. So the balance carried down is 40,000. Now students, this balance would be brought down onto the credit side. So on 1106 by balance brought down 40,000. Again, at the end of this year, we have used 40,000 rupees for the whole year. So interest would be payable. Entry would be by interest, that is 10% of the balance in the beginning of the year, which is 40,000. This gives us an amount of 4,000. On the same date, that is last date of this year, payment would be made to bank account 20,000 plus 4,000 as interest, 24,000. Then balancing this, balance would be 44,000 minus this amount of 24,000, which is 20,000. So students, the balance remaining at the end of this year, that is the second year, in the loan account is 20,000. This balance would now be transferred to the third year as the opening balance. So the date would be 1st January 2007 by balance brought down 20,000. Again, The same process would be repeated at the end of this year. Interest would be due at 10% of 20,000, which is 2,000, and on 31st December this particular year, that is 2007, the entry would be to bank account 20,000 rupees for the installment plus 2,000 for the interest, that is 20,000 would be discharged completely, and there will be no balance in the loan account. So the total is 22,000 both the sides. And remember one thing, that since it was given in the question, it is to be discharged within 3 years. So after the third year, there should be no balance in the loan account, and all the interests together with the installments have been paid.